What can I afford to buy if I make $70,000 or if I make $170,000? If you can afford to not make a purchase, hear me out, don't buy. I want to give you the formula you need to know to identify if you should buy or shouldn't. The formula that can help you conclude, can I afford to or not afford to? So as we unpack the concept of affordability, it's really good to understand that many times you're going to hear consultants and advisors talk about two different aspects of affordability. They're going to be defined by a front end ratio and a back end ratio. A front end ratio is going to be in regards to what is the percentage that your mortgage payment itself is in regards to your income, your gross overall income. And then the back end is going to be what is the percentage of your mortgage payment or your housing payment and all the monthly obligation debt you have in regards to your gross income. And in those two different categories of debt to income ratio, as people speak about affordability, there's two other categories as well to make sure we identify. The first category is going to be conventional wisdom. This is where the self-proclaimed financial planners, the advice experts, the gurus on what to do and what not to do in finance come out and try to give you rules that are broad strokes applied to all people, whether you're in Ohio or Southern California. You get these rules of, hey, don't allow your mortgage payment to be more than a third of your take-home income, or 35%, or 37.9%, or 41.6%. There's so many different variations of ratios I've heard. It gets pretty confusing. The second category, and on the other hand, you have not just conventional wisdom, but qualification requirements. Qualification requirements change very often. And in addition, qualification requirements can be much higher than just what conventional wisdom says. So for example, if we show here that we have conventional wisdom on one end, and then we're going to have qualification on this end. From there, conventional wisdom, right? You have 30%, fix that 30, 35%, 40%, 42%. It's what a lot of financial consultants would try to advise. And then when you have qualifying wisdom, we have the aspect of seeing some loans go up to 55.9% on the back end ratio. You have others that in best case scenario would be 49.9%. And then you have others that can be about 45% with, in addition, ones that would be a little closer to this 42% conventional wisdom, 43%, and so on and so forth. Every different type of loan is going to show a different type of requirement. And in these two different categories, if we try to take these two as plumb lines to help us conclude what affordability is or isn't, we can get really, really confused. Here, great books are sold upon these rules. Here, a lot of money is made from banks in regards to these allowances. So how do you exercise the fiscal responsibility you're attempting to exercise to be able to get into the home you want and still know you're making the right move? I'll give one hint here and one rule of life that has helped me. And then at the end, I'll share a little bit more about this hint and rule that I've been very, very proud to stand upon. And the hint is going to be making sure that you understand affordability is a tool to help you live your life. It's not a slave master for you to suffer underneath. And I'll say that again. Affordability is a tool to help you live your life, not a slave master to make you suffer underneath. So when we're looking at this tool and trying to identify, how does this help me? What should I do in regards to this tool? The first question we have to ask ourselves, and the reality we need to have with ourselves, is, am I being honest about what I can afford or not? We have to be able to look at ourselves, take a hard, strong look and say, Not just do I need to answer, can I do this? But I need to be truthful and say, should I do this? Do I want the lifestyle that this new obligation of affordability with the mortgage is actually going to create now? And so to take this tool and again, compare the conventional wisdom and the qualification rules, these two sometimes extremes that we get exposed to, let's draw out a scenario. So if an individual is making $70,000 annually, and we're going to be using the 35% of your take-home rule, then that means 35% is going to be calculated off of a take-home, which I would estimate is going to be about $4,887 before any type of benefits, 401ks, anything like that. Just from a tax perspective, I would estimate $4,887. If we're using 35% of that take-home number, that means that your allowance of monthly obligational debt is actually going to be $1,857 and 32 cents to be exact. Now, in the same situation, as we compare with the $70,000, if we look at a conventional loan, right, and we're going to assume qualifications at a 49.9% loan, the monthly income we would use is not going to be take home, it's going to be gross. Gross would be $5,833 and 33 cents to be exact. From there, this formula would leave us at a monthly allowance of $2,910.83. The difference between these two is how much? $1,053 and 51 cents. So the question now arises. Sosi, if I'm trying to use these rules, and one rule or one guidance and one set of advice is telling me I shouldn't exceed a monthly payment of $1,857, and the other one is telling me $2,910, that's a big difference. $1,053 is massive. That's going to be heavy for me on a monthly basis. And let me share something. If I help you get a loan and you're going to have that thing for 30 years, the last thing I want to do is see you hate me every month you get that mortgage statement. And so this is where we want to have that honest conversations with ourselves. Can I afford an increase of $1,053? And just because you can qualify up to this amount doesn't mean that you should. So the guiding principle here would be, if my rent right now is somewhere around this number, this $1,857, the next question is going to be, what am I actually including in my budget that maybe I need to think twice about and see if I should take out? For example, eating out. How much am I eating out? Splurging on toys that are unnecessary. How much am I spending on a monthly basis there? Another example, shopping. What am I buying regularly that maybe I truly don't need? What credit card debt or loans should I focus on paying off? Because once that's paid off, what is available now? The payment I was paying there. So when we take an honest look, the question we want to ask ourselves is, am I spending this number here in any one of these areas? It's a terrible arrow, my apologies. And if you're redoing your budget and seeing that you are, well, you might realize that you can actually afford to buy without even realizing you could have afforded to buy. And some of the other aspects that happen when you do put yourself in this variable and you do rebudget your life and look at your expenses and see, am I actually already paying a mortgage, but instead of paying a mortgage payment, I'm splitting it between rent and other things that are excessive and not necessary? Another thing that happens in this situation here is it's not considering any potential renters of one of the rooms you might own. It's not considering the future wealth that this house creates for you. It's not considering the fact that in many times you see people who do have a mortgage payment work with more clarity and end up earning more money. Even just from a sanity perspective, having security in a new way creates so much more for you. Whether that just means that you're in a position where you don't have to walk your dog every night and you're not as stressed out and you're able to live your life with more ease, and you see that now also bleed into work life with more efficiencies and being able to climb the ladder in a faster pace. Those are all variables that we never analyze. So again, this tool of affordability, this tool of making sure you identify not just what you can do, but should do, this common rule, seeing that affordability is your tool. It's your tool to help you clarify the path to your home, or it's your tool to help you clarify the path that your home needs to be something that you get later on. With all that said, that now brings us into a new conversation. Okay, if affordability is a tool, and it's up to me to identify how I want to utilize this tool through honesty, self-reflection, and writing out a budget, help me understand what can I potentially qualify so that when I look at my budget, I'm actually in the realm of what is possible, right? And so as we discussed already, when you're looking at a $70,000 employee, what that would equal to is going to be about a $2,910 monthly payment. So what home price would that be? Well, let's look at some numbers here. Assuming qualifications, right? If you have about $70,000 and you have no other monthly debt, you have paid everything off fully, then in this position, you'd be able to see that at a $535 purchase price, your monthly payment with estimated taxes, insurance, everything included is $2,901. And that's going to be looking at this from the perspective of about a 5% down payment with closing costs and everything together. That means that somebody hypothetically, if they are making $70,000 of household income and have no debt whatsoever, could potentially qualify for this $535,000 house. In the same respect, someone who's making $170,000, their debt to income ratio is going to be allowing for much more in qualifications. They would actually be allowed up to $7,069 of a monthly payment. Yet there's a limiting factor here. If you're making that amount of household income and we're using the regular qualification rules and assuming all other aspects of qualifications, the hindrance for you here is going to be what's called the loan limit. And so in some areas, loan limits are higher, in some areas, loan limits are lower. If we're looking at what are the higher loan limits available in the United States, it's going to be about 822, 300 and some change. And so to kind of just use ballpark figures here, that person or household that is making $170,000 could potentially qualify for $905,000 of a purchase price, leaving them well below their max qualification monthly payment at a monthly payment out of $44.99. And this is, again, assuming the down payment here would be 10% with prepaids and closing costs included. So bottom line, somebody at $70,000 household income with no debt could potentially qualify for $535, and somebody with $170,000 of household income with even some debt could potentially qualify for $905. That's what would be here and now today. What if, though, we're looking at the future? If you're watching this, I'm assuming you are an analyzer and you're a planner, and so you're probably thinking of this from a preparation standpoint, and I salute you for that. That is great. Now, as we think about a 4-year projection and we look at what the average appreciation was before COVID, on a yearly basis, houses were growing, in worst case, 3.69% across the country. That means that if we use this same worst case scenario, this house that's worth $535 in 4 years would be worth $618. If this house is now worth $618, and let's say interest rates rise 1 percentage point in 4 years, which 2 years ago from right now, we're already about 1% higher. Let's just say it rises 1 percentage point in 4 years at a 4.125. Now you're going from $2,901 for the 535 house to $3,685 for the same house that's now worth 618. That means that in this 4-year growth, you qualified for 535 at $70,000, again, assuming qualifications in all other areas. And now you have to make about $88,000 to qualify for this same house, but now at a higher purchase price and a lower rate. That means that you have to have a growth of income of more than 22% in order to be able to buy this house later on. In that same situation, let's examine the household income of 170 grand. This person who buys a house at 905, hypothetically in 4 years could sell it for $1,046,155. And if, again, the same scenario of rates go up 1 percentage point in 4 years, you'd be seeing your monthly payment go from $44.99 to $51.89. Well, it's not that as big of a difference. I was expecting a little bit more, but now keep this in mind. This is now with you putting about 20% down, because the loan limit here might go up, might not go up. But let's say you're aggressively trying to save and you're going a jumbo loan, which is the type of loans available for those loans exceeding that county loan limit. If you're putting 20% down there, you're now seeing an additional $120,000 of funds needed to be able to close on this new house. So you wait 4 years to buy the house at $1,046,000. Your payment goes up $890. And from there, you're also having to bring out an extra $120,000 out of pocket. Yet on a jumbo loan, many times reserves are required, which means that you take your monthly payment and you got to have a certain amount of those payments set aside. If the jumbo loan is requiring you to have 6 months reserves, that now means that you're going to be in a position where not only is there going to be $120,000 more needed for the loan, not only is there going to be a position where you now need $120,000 more just for the loan, but that additional 6 months of reserves, $31,136, is going to put you at a total of $151,307 needed to be able to buy this house in 4 years with this scenario, the same house that you could have bought in this one. That is where, when we look at the practicality of affordability, of qualifications, and we actually start analyzing affordability for what it's supposed to be, a tool to empower you to accomplish your goals. The conclusion for this is coming to the fact that affordability is a tool for you. It's a tool that's going to be able to help you not just answer the question, what can I afford? But help you also make the decision in regards to, if I don't do this, what will it cost me? In other words, can I afford not to do this? Affordability is so relative. Affordability is all going to be defined upon what kind of life you're trying to build. Because like we said already, affordability is a tool to help you build that life. Take advantage of this tool. Look at all your numbers so that you can identify what's going to be best for you, your family, and your future. I know in my own situation, it was a very hard jump to go from renting to home ownership. And a lot of that for me was based on my background. I didn't grow up in a household that taught financial literacy. I actually grew up in a household where the house I grew up in, we no longer have in our family. This came from bad advice and bad decisions that ended up making my family lose this home. And in that scenario, it affected me greatly. I never wanted to be in a position where I couldn't afford the house that I had my children grow up in, and I had my family there, and my dog running around in the backyard. The goal of buying a house is never to lose it. And knowing that it can be lost from personal experience made me take a real hard look at my own circumstance. And as I saw my monthly payment go from rent to mortgage almost in double the amount on my first home, it scared me. Made me think twice. And the ease came in when I put all the numbers down on paper and let the black and white reality speak for itself. If I cut out these things that were not necessities for the sake of getting the home I truly wanted to build the life for me and my family, which was a necessity, could I now afford this house? And in my situation, the answer was yes. And that house turned into the funds I needed for the next home. And that home then was used to be able to renovate and grow wealth. And from there, we're in a beautiful house that I love having people come over and see. I love seeing my children enjoy. And I love seeing us be happy in. And if you want a second pair of eyes, or you just want somebody who wants the best for you, because we don't need to twist anybody to get into a home that they're going to regret, reach out to us. Our mortgage advisor team is here to help you process those exact scenarios so that in the years to come, when we touch base again, we can either be glad in the fact that you didn't buy, or we can be glad in the fact that you did. Please, 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 if you find any of this content helpful, please like and share, subscribe. It makes a big difference for us in the community we're trying to impact by being able to give out the good advice that we believe individuals should have, yet it was never provided. And so again, if you like this, please like, share, subscribe, so you can have all this information. Look forward to being able to help you guys in your journey more soon. Thanks so much and have a great one. Bye-bye.